Joining us now is Paul Hickey from Bespoke Investment Group and CNBC senior economics reporter Steve Liesman. Steve, I'm going to go to you first because we had a CPI report that was better than expected, both in terms of the headline number and in terms of the core. And what we've seen is this dramatic repricing in the market around when investors think the Fed is now going to start cutting rates next year. Walk me through it.
Yeah, I think I'll reveal what I said on the morning news call. I said it was possible we could have an upside surprise and the market would like it. I had no idea that the market was this wound up about getting rid of the possibility of additional hikes, but B, that a little beat would cause the market to really accelerate its timeline for rate cuts. Now, let me walk you through where the market is priced now. Zero probability in December or January or forever after that for any rate hikes coming. In fact, there's a very slight 3% probability of a rate cut built in for the January meeting. And the result, when you look further into next year, when you look at cuts, is a dramatic increase in expected cuts for next year, a 34% probability for March, and then it keeps moving on until you get into 100% probability. And what you're looking at on that chart right there is how much in the way of cuts are built in, 100 basis points for next year, whereas the Fed is only 28 basis points built in. So what's happened is a small beat. I really think the market's taking this data a bit too far, Morgan, because I don't think the data is going to be as consistent. I think inflation is going to drop. I just don't think it's going to be consistent as the market seems to have priced in.
It wouldn't be the first time we've seen the market go against what the Fed has been saying. But Paul Hickey, if I look at the S&P 500, we closed just below 4,500. 44.95 to be exact. I think it was just last week we were closing above 4,400. Again, the state of this rally and how strong it was and how strong the breadth was today, does it have legs? Do we know yet?
Yeah, so I think, Morgan, to your point, we had this correction which was driven by higher interest rates, higher crude oil prices, higher dollar, and then you threw on rising geopolitical tensions, and they've all come in a little bit. A lot of the rally we saw was on confidence that the Fed was done hiking rates. And I think today there's a certainty that the Fed is done hiking rates. And that just added more fuel to the fire. And to paraphrase Powell, we've closed the effing door on rate hikes. And now we're going to look ahead. I don't know if the market may be getting a little bit ahead of itself on when the cuts are going to come. But I think the rate hikes, as I think Steve would agree, are probably done unless something crazy happens with the data. So in that respect, and then with the strong breadth that we've seen, this is crazy. The Russell 2000 outperformed the S&P 500 today by over 3.5 percentage points. That's only happened right after the 87 crash in October 2008 and October 2011. So that doesn't happen very often. And when you see similar types of outperformance on the part of the Russell, versus the S&P when the market is up, going forward, you have tended to see small caps outperform the vast majority of the time. So we've been waiting and waiting and waiting some more for small caps to start rallying and to outperforming. And maybe this could be a sign that we're seeing it.